morning, everybody. Welcome to the morning market briefing. It's Wednesday, April 20th, 2022, 420, big day here at the office because we are, of course, in Suite 420. So excited about that. Anytime we can have our own little holiday and see everybody on Twitter celebrate us, it's a pretty special occasion. Tom, Ben, how's it going?
Doing well. Great day. Smoking, we got him.
Yeah, there we go. we'll jump in. I don't got him. So we'll just jump in. Talking Bank of America a little bit, some interesting perspective on treasuries. Tom, obviously we've been talking about interest rates, yields, a pretty volatile fixed income market in general. What are they doing? What's the big takeaway? Do you agree with them? So
Bank of America's come out and said that they have gone long the 10-year, and I think it's a compelling level for the next 3 months. And they said, quote, our forecast points to inflation peaking this quarter and falling steadily into 2023. We believe this will reduce the panic level around inflation and allow rates to decline. So functionally, they went long at 2.83%, and they're targeting the 10-year coming back down to 2.25, but they've got to stop it at 3.10. And so in my mind, I don't really see a point where we have a real backstop in treasuries or in bonds in general until this May meeting, which is roughly 2 weeks from now. And so I think that on the whole, they're probably right. I think we're oversold. I think the bond market has really faced a huge lack of liquidity. There are not a lot of people who are just stepping in to buy in bulk. When we look at the bid markets every day, we're getting stuff that we haven't seen in years. I mean, we're back to yield levels that predate my trading bonds. We just haven't really been at muni levels or taxable muni levels or corporate levels of this spread, as long as I can remember, as long as I've been trading bonds, and it continues to get worse and worse each day. So in my mind, I think that a little bit of clarity from the Fed on and the May meeting is going to essentially put in either a backstop or we're going to go the other direction. And so if you look at, the futures right now on the potential hikes, right now we're over 2 potential hikes in terms of the implied probability. So it's roughly 1% chance now that we'll get 3 hikes, but we're actually forecasting over 2 for the first time really this year, or really since the beginning of us talking about the potential hike scenarios. And so, I just don't see that being a positive for rates in the short term. So my guess is that we'll probably approach 3% on the 10-year. We may get over that before we hit that Fed meeting, but I think we are a little oversold. I think that there's going to be a point where people can stomach these yields. We've had a lot of clients and potential clients that we talked to who are saying, why don't we just go 100% into bonds now? Getting, if you can get 4% tax-free forever, that's a pretty good deal. And in some of these bonds, we're getting, upwards of, a little higher than 4%, which is crazy. And that's on 5-year AAA munis, which is really unheard of in the last 15, 20 years. So I think there's going to be a point where the losses are in and people are going to want to get in hard on bonds and lock in for multi-year returns that are, somewhere in the 4 to 6% range, but I just don't think we're there yet. But I do like that they're saying it. The more banks that come out and say, hey, let's go long treasuries, the more stability we're going to have, because the Fed is definitely not doing that, and over the last couple of years, in order to stop, big bond bleeds like this, we need the Fed to step in and say, hey, we're back in the market. And at this point, they're basically doing the opposite. They're saying, we're not doing anything. If anything, we're getting more aggressive.
Do you think Jay Powell's going to say anything tomorrow when he talks with Christine Lagarde, or do you think it'll be more of the same, 2 rate hikes, and we're going to do quantitative tightening in May?
I think his verbiage is probably going to be exactly in line with what he said. We're looking at it. 2 seems appropriate. Obviously, there's going to be a discussion. They're definitely setting the stage for unwinding the balance sheet. And I don't think he's going to deviate too much, because any deviation, I think at this point, is going to be cause for concern. I think he's just got to stick to the script. And if the surprise comes with a triple hike, so be it. But at least Jim Bowler's already come out and been that guy who set the table for that. So there's no, it's not going to be a massive surprise if someone's already talking about it within the Fed.
Yeah, it's weird, just the emotional or the psychological impact of actually seeing what could still be argued as relatively low yields on fixed income if you look at the longer history. But, I haven't done this for 11 years. It's, I've never seen a period where you could pretty consistently for a prolonged period pick up yields that are pushing 4%. And Yeah, it's just interesting. I mean, I feel like we've had this battle of the importance of fixed income. We certainly saw it, prove its value, especially once we got the recovery after the Fed stepped in 2020. And down periods, you've traditionally seen the benefit of that asset class. But the odd part is I feel like we have clients saying, hey, should we just be loading up on bonds, even though bonds are actually down right now? And I think their line of thinking is generally correct. I mean, for context, we had somebody I was speaking with earlier this week that has kind of one of those collared annuity strategies. It's linked to equity returns, but you'll never get a 0% return and you're capped at 4.5, something like that. And I just kind of tell them, I was like, look, if you're in it, you're in it. There's nothing we can really do about it without paying a ton of fees. But, right now we can get you that return on a tax-free basis just about, which is just a very, very quick reversal.
And this should be awesome for the annuity companies because they're going to be able to lock that in, and they're not going to have to do anything for the next 20 years.
Yeah, they can de-risk.
And they'll just take all of the cream off the top.
Yeah, it's. I think that although what is happening is what I would have expected, it's just happened faster.
Yeah.
And I don't imply that that's wrong. I think it's relatively healthy and there is a path forward, and the upside is we're buying pretty attractive paper right now.
Yeah. And it's excellent for those who are in retirement or taking income. Every time a bond matures, we're going to be making 2 to 3 times what we used to make on the same bonds, and credit quality is increasing. And I think that's something to continue to stress, is that the bond market is getting cleaner and cleaner, but the prices are getting lower and lower. And that's an ideal scenario for, continuing to work into ladders over time.
Yeah. And I think the ladder piece is huge. I mean, we, at any given time, I think the tendency or the temptation is to just find the biggest yield. I think you see that a lot with retail investors. I think you see that a lot with professional investors that maybe are just buying ETFs or mutual funds based specifically on what the quoted yield is. That is the temptation, but doing so can lock you in a way that's not favorable. And having money constantly coming due is just where you want to be. Netflix hammered second quarter in a row. We're down about 65% from Netflix's 52-week high, which was over $700. We're at about $250. Absolutely crushed, down 27%. Ben, people have probably seen headlines. I mean, I would argue this is probably the single biggest earnings story we've had really in a couple quarters in some ways. What's the narrative there, and how does Netflix try to crawl out of this?
Yeah, this is the biggest earnings headline since the last Netflix earnings report.
Yeah.
I think we're moving from a period of low interest rates. We're moving from a period of low energy prices. We're moving from a period of low travel prices. And I think that everything that we saw in COVID is reversing. So we're taking out some of those high COVID sales. We're taking out some of those high stay-at-home stock valuations. And Netflix is kind of an epicenter of stay-at-home stock. A lot of people just had Netflix on while they were working during COVID. So Netflix actually lost subscribers in the quarter. Part of that was due to Russia, but they would have missed the estimates anyway. They still lost subscribers in the US and Canada, and they expect to lose even more subscribers next quarter. In fact, 1% of their subscriber base, which puts them at about 220 million subscribers at the end of Q2, versus an estimate of 228 million. So they're 4% short of what analysts were expecting in terms of total memberships. The big thing that Netflix is facing is the saturated market. Right now, they list 4 problems. They say that not enough people have internet. They say that they have a bunch of freeloaders on their platform. In addition to the 222 million paying households, they have over 100 million people who are consuming Netflix content who aren't paying, who are potentially a member of one Netflix account, but not paying for it themselves. They do note that competition has increased, but they say they've dealt with competition fine over their 15-year period of streaming. And actually their market share has actually stayed relatively good. And they say macro factors like a weak economy, inflation, Ukraine, COVID, all of that. I think the biggest thing for Netflix is that saturation factor. So what they're doing is, rather than trying to expand the market, they're trying to just get more money for the shows that they actually sell, and for the subscribers they actually have. So a couple of ways they're looking about doing that is that they're going to be more open to advertising. So think of a little bit more of a Hulu model where you can have kind of a freemium tier where you're going to have to pay a lower fee, maybe, I don't know, $5 to $10 a month. And then you have to watch ads or an increase in the price of the base product. Or they're going to be stricter on password sharing. You can't have so many accounts per household, for instance. So what they're trying to do is grow average revenue per user even more than just growing the subscriber base. And my concern with that is, as they grow that in an era of competition, will they have some subscriber attrition as well? So it's a really interesting scenario. I think that they missed a boat. They admitted they missed a boat because in 2021, everything was complicated due to the COVID impact and the coming off of COVID. Now they realize there are more systemic issues at the company and they're trying to address them, but it's going to take some time.
Yeah, and I think my concern for Netflix is really twofold. One, we've seen a number of tech companies struggle with that migration as they try to get Wall Street and analyst community to focus more on ARPU as opposed to overall user growth. That's a tough narrative to switch. You know, when you're valued as highly as Netflix has been in the past, based solely on subscriber growth, switching gears and saying, hey, we'll look at the efficiency and the revenue generated per user is a difficult story to sell. So that's going to be a challenge. The other thing is a lot of their solutions kind of seem small relative to the overall trend. I mean, I think if you crack down on password sharing, if you crack down and started adding a cheaper model where you have ads spliced in, if you do all of those things, they will help potentially, but I don't know that they pull you out of this general trajectory. So I think it's going to be a challenge for Netflix moving forward. Ben, we heard from a number of other companies on earnings. ASML, a semiconductor producer based out of the Netherlands, really kind of focused more on the memory side, looking pretty positive, not only in how they perform, but also outlook. Stocks up a little bit more than 6% pre-market. What would be your read through as we start to think about other companies that are due to report?
Yeah, I think that ASML is a big equipment provider for semiconductor companies, and they had bookings that just blew it out of the water. Estimate was 4.5 billion euro of bookings that came in at about 7 billion euros. So they're really rethinking their 2025 growth profile in a positive direction. The big takeaway is, I know we talked about CFO confidence and CEO confidence, and that continues to be an area that we're watching closely. Having said that, despite what we're seeing on some of that survey data, clearly semiconductor companies are sticking to aggressive CapEx plans. And if we see that trend continue throughout, in terms of industrial companies continuing to stick to aggressive capital expenditure plans, that could continue to be a positive story for the market. So that's a good one that I certainly was surprised about, given some of that other survey data that we've seen. In terms of the other companies that we're talking about, you had Abbott and Procter and Gamble report earnings this morning. Procter and Gamble makes anything from dishwasher detergent to laundry detergent to just paper products. And they produced a very strong quarter. It was actually one of the highlights was actually the baby segment. And one of the reasons that they're doing so well is just pricing. Volume actually came in broadly in line with expectations, but pricing is really doing a lot to offset some rising commodity costs. And as a result, they were able to actually reiterate their earnings guidance for the year, despite having significant impacts in terms of foreign exchange, commodity costs, freight costs. So that was a good story. And that just speaks to the power of the Procter & Gamble brand.
Are babies back?
They were up double digits in the first quarter for Procter & Gamble.
Man, these kids.
I'm telling you, everybody I know is having a child.
Not me.
Just a little bit ahead
Not Ben.
ahead of the curve.
Tom's lying. Tom's lying. Not everybody. Logan's not having a baby.
Not yet.
Not yet.
There are two kinds of people: those that have kids and those that will.
Sort of.
Sort of, yeah.
Abbott reported earnings too. Abbott really benefited from strong COVID sales. This is one of those examples of companies that really benefited from COVID, but now is trying to, in that digestion phase. It's not to the extreme scenario of Netflix, but they're trying to have some digestion there. And they beat the estimates, but it was a low quality beat because it was all driven by that COVID testing, which isn't going to continue. So we of course have Tesla tonight, which will be a big one. And then Union Pacific, you have tomorrow morning. So some big companies coming up. Tesla will be very interesting. Will Elon Musk be on the call or not? And will he talk about Twitter?
Yeah, I think it'll be interesting on Tesla. I mean, that will, I would imagine, be the big headline as we have the call tomorrow morning. It will be interesting to see, obviously seeing, some of these more aggressive tech-oriented companies like Netflix really taking on the chin. It's an opportunity for Tesla to really, if they executed, really demonstrate that and show some staying power and sustainability. So it will be interesting to see. And then certainly the commentary, whether Musk is there or not, something to keep an eye on. We'll wrap it up there. We'll be back tomorrow. Hope you guys have a great day, and we'll talk to you soon.